But the core of the fight over the shutdown right now is one wonky but deeply important issue because it impacts millions of people. Health insurance subsidies.
The U.S. economy is on the verge of total collapse because consumers can't afford inflation and the cost of living crisis it creates. And with premium tax credits for the American CARES Act about to expire at the end of 2025, it's going to cause over 22 million Americans to have health insurance costs skyrocket by over 130% on average. In some states, it's over 300%. Now, this surprise new hit to mom and pop is going to cause even more household debt to become delinquent. Now, as it stands right now today, consumers are laid on roughly $1.42 trillion of household debt. That's a delinquency rate, guys, of 7.8%. And that's going to get much worse, which will cause an increased delinquency in the commercial debt and private equity, leading to the greatest debt and dollar crash of our lifetime, predominantly caused because we have a government who robs its people. And having said that, welcome back to Real Estate Mindset. Happy Friday. You guys already know this video is going to be absolutely bonkers. Coming out yesterday from Zero Hedge, extending the ACA subsidies, which stands for American CARES Act. Over the last week, the decision on whether to extend the enhanced ACA subsidies has increasingly become the defining issue of the shutdown. From the onset, the Affordable Care Act subsidized the purchase of health insurance by some lower income Americans on the health insurance exchanges. Now, the subsidy was costing the federal government about $50 billion annually. A poll from Kaiser found that 77% of Americans want Congress to extend these subsidies. More than 22 million people rely on the Affordable Care Act. If the credit enhancements expire, about 4 million people will lose their marketplace coverage and become uninsured, according to the Congressional Budget Office. That is absolutely wild to me, because when we look at who's taking advantage of these subsidies, it's not rich people, you guys. In fact, look at almost 50% of these people make about $31,000 a year. Okay, that's it. Less than 30% make $47,000. Do you guys see that? So this is for low-income people in poverty. The problem is the gauntlet of fraud between our tax dollars and those people. 32% of households making less than $50,000 are on this program. Okay. 31% of the households on this program make between $50,000 and $100,000, 22% from $100,000 and $150,000. And again, you guys, this is the total household income. In 2025, they get $14,920 in total premium tax credits. When I first read that, I'm like, wow, that's why my premiums are $14,000 a year. So unfortunately, in order for them to get that tax credit, I have to pay that amount of money for my premiums, which is a bummer. In 2026, if the PTC enhancements are extended, it's going to go from, again, $14,920 all the way up to $18,624. But the premiums only go down by $300. So in the first case, the premiums were $4,100, but if it passes and they're extended, it goes down to $3,800. If the enhancements expire, the total premiums are going to go up to about $7,500, but they're still going to get a credit of almost $15,000, which also means that there's a massive problem in healthcare. Look at how this adversely affects different states. So far, the U.S. average with enhancement premium tax credit is $460 annually. So I was like, wait, not monthly? That's annually? Like, I didn't know people could still pay $40 a month to get insurance, to be honest with you. But that's going to go up from $460 on average to $1,087, which represents a 136% increase. But look at some of these states, guys. Alabama, that goes up 284%. Alaska goes up 346%. Arizona, 138%. Arkansas, 144%. Mississippi, I mean, there's already poverty there. Their insurance is going to go up 314%. That's insane. North Dakota goes up 234%. In Texas, my home state, it goes up 289%. But look at West Virginia, 387% increase. That's not fair. Look at Wyoming, 382% increase. You guys, it is going absolutely wild right now in the health insurance market and is absolutely destroying so many Americans. It's absolutely crazy. Now let's listen to a video from a man that's paying $25,000 a year in premiums, who's actually well off, but is considering eliminating his insurance because even though he's successful, he can't afford it any longer.
We are 5 weeks out from open enrollment, the day when we can all sign up for our health insurance. I took a closer look over the last week and realized that sky high prices continue. I have a family of 4 and I'm paying over $25,000 a year solely on health insurance premiums, over $2,000 a month. And my deductible is still $7,500, which means my insurance doesn't really kick in until I spend $7,500 on medical costs that are actually in network. I'm at the point, honestly, where I'm thinking about foregoing health insurance entirely, which sounds like a pretty crazy and scary concept, but here we are. And how did we get here? Well, full disclosure, I used to work for a major Fortune 20 health insurance company for over half a decade. Know a thing or two about how we got here. I spent some time working on legislation, regulation, and legal issues, and I'll break it down for you. So, before the Affordable Care Act, aka Obamacare, insurance companies were actually able to deny people insurance if they had complex medical conditions and or pre-existing conditions, commonly termed. And then after Obamacare passed, insurance companies could no longer deny anyone who wanted insurance. And they also were further restricted on what they were allowed to price the insurance based off. Think of risk factors. So now, on a go-forward basis, health insurers can only adjust your premium based on age, tobacco use, and location. So as a result, more people than ever now have health insurance, which is obviously a good thing, but the prices have skyrocketed as insurers are on the hook for ever-increasing medical procedures, hospital costs through the roof, drug prices are exorbitant and continue to increase, and the American population is generally morbidly sick and obese. So here we are. Honestly thinking long and hard about whether I just forego insurance entirely this year. Would love to have an extra $2,500 in my pocket a month to pay for food, eggs, which feel like they're $100 a carton now, and would love to hear what everyone else thinks.
Mitch, before we go on in this video and explain to the viewers how what we just talked about is going to cause a total market collapse and completely bury mom and pop even more than they're already buried, I want to talk to you about whether or not you think that we should scrap this program. And I also want to tell the viewers, personally, I think as a society, this is the United States of America, we should take care of our elderly and people that are so sick they can't make enough money to even cover their medical costs. The problem that I have with the current program in place is, as a result of taking care of those people that I do want to take care of, I can no longer afford my insurance. I have to cancel my insurance because I can't afford to pay $1,000 a month. Plus, I have procedures every year that cost another $5,000. So I'm paying almost $20,000 in medical insurance, and I only have one procedure per year every single year. So I think that we need to cancel this program, and we need to figure out how to help these people directly and remove the gauntlet of fraud, greed, and corruption between us, the taxpayer, and the patient. But I 100% believe this is the United States of America. This is 2025. As a society, a great society, we need to take care of these people. Mitch, what do you think we should do with this program? Do we continue it, cancel it, bring something else back? What do we do next?
More than likely, based on the fraud in the system, the program is going to cancel itself. Now, human beings, being the politicians, will try to monkey around with this again and kick the can down the road again. But the math has gotten so far out of hand and the fraud has gotten so far out of hand. Even the 22 million people that you were talking about a minute ago, that number is not even close. And the reason that it's not even close is that you've got a domino effect here. And as you were going through that, I just was putting together a handful of items. But you've got a home loan mortgage. You have property tax. Approximately 9% of the median household gross income is going to that property tax. You have fraud at every level of the school district associated bonds. You have credit cards. This is what most people in their houses have, regardless of their income. So there's credit cards clicking at 24 to 30% interest. There's healthcare costs. There's fraud in that system, just like there is at the CADs and the school districts. You have private loans. A lot of people have private loans to help keep the roof over their head. That's at a high interest. There's buy now, pay later loans, i.e. they need a piece of furniture, they go out and get that. Well, that's 30% interest clipping away on something that the second walks off the floor is worth nothing. And all of those, you start adding that up, well, that shows that you're going to have an increase in hunger. People can't afford food. You add to that the increase in the crime as a direct result of all those items. And it comes back to what I've been pounding the table on. Nothing else matters but the median household income. And the money doesn't exist to pay for any of these items we just went over. That's the problem. So mathematically speaking, this system is going to self-destruct. And Travis mentioned the idea of the debt crash and a currency crash. Well, currencies, because this is not just a United States problem, this is a global problem. London's economy is in worse shape than the US economy. Germany is dancing on a depression. So the idea that the British pound is stronger than the US dollar is insanity. And currencies are going to do what they do. But this is even going to affect that and affect those futures as well as the underlying payments. But you can see when you go to a grocery store that your purchasing power of your US dollar is disintegrating. That's called inflation. Inflation is a hidden tax, and the hidden tax is created when they print money, which is a fraud. It's called counterfeiting. All of these things are hooked at the hip. There's a lot of greedy people here that did things to kick the can down the road and get bailed out when in fact they should have gone bankrupt in 2007. We're living with those ramifications. The point that I'm getting at to all of this, the 22 million people isn't even close. This is a domino effect. This is a waterfall effect. And the system that anything that touches fraud, you've got to put a floor and a ceiling on it and start peeling it back. Yeah, I think some or a good portion of the principal can be saved. But those who made profits on the fraud, no, you're not going to get the money back.
Speaking of not getting the money back and speaking of the system, let's go into household debt now. And I want to show the viewers how much household debt, the category of the household debt, and how much of that debt is currently delinquent. Remember, you guys, if they don't extend those credits, all of the trends that I'm about to go over with you right now are going to accelerate. And one more thing, remember, these trends I'm going over with you are lagging. Student loan borrowers face reckoning with 29% delinquency rate. So when we look at the total amount of student loans, which is right here, you guys, you see that we're in $1.7 trillion in student loan debt. Now, I'm going to remember all of this and I'll add it up and tally this for you guys at the end. But what you should know is 29% delinquency of $1.7 trillion equals $493 billion worth of student loan debt that's delinquent right now. And when we look at buy now, pay later, the tracker is stating that 41% are late in the past year. And more people are using those loans for groceries. And I'm going to read a couple key findings here. Nearly 1 in 4 say they have 3 or more active buy now, pay later loans, and more users buy groceries with buy now, pay later. For a total of 25% of users are using these types of loans to purchase groceries. The total buy now, pay later marketplace is projected to reach $560 billion in 2025. That gives us an additional $229 billion that's currently late. When we move on to credit cards, and this is actually super surprising to me, the percentage of credit card debt that is 30 days delinquent. I want you guys to pay attention to the blue line, which represents total US. Look at the trajectory. It's skyrocketing upward. And if we trail this back all the way to the global financial crisis, we are near the peak of the global financial crisis. Now that represents, and this, again, this is shocking to me. Look at, so I'm kind of guessing it's about right here. Is that 13%, guys? Look on your screen. The total amount of credit card debt that's 30 days or more past due is 13%. Is that not crazy to you? And when we look at the total amount of credit card debt, that's $1.04 trillion, which means there's $135 billion that's also behind. So we're going to add all this together at the end. When we look at auto loans, also pretty crazy, you guys. 5.1% of Americans with auto loans are delinquent, which is absolutely crazy to me. And when we look at the total amount of vehicle debt, it's at 1.56 trillion, which means when we take that 5.1% delinquency rate, that's an additional $79 billion of household debt that's currently late. Americans owe $257 billion in personal loan debt, okay? And that accounts for, this is a surprising number to me, 24.8 million Americans. So 24.8 million Americans, the delinquency rate, and they're counting 60 days. I'm happy with just 30 days. I don't like the 60 days, so my numbers are conservative. But the delinquency rate on all of that, you guys, is 3.37%. That's an additional $8.66 billion in household debt that is behind. And lastly, when we look at home loans, which is incredibly difficult to calculate because of loan modifications and data providers hiding data. But this is essentially saying, okay, first of all, that the delinquency rate for home loans is 3.68% and that the total amount of debt is 12.9 trillion. So when we take the 12.9 trillion and multiply that by 3.68%, that means that $474 billion in loans right now for homes are behind, which gives us a total amount of $1.42 trillion conservatively that consumers have not paid. You guys, that is a total delinquency rate on all total household debt, at least what's on the surface, of 7.8%. Now, before going to Mitch, I want to listen to some boots on the ground testimony of an American, a young American that he can't live. Listen to what people are going through right now.
If I knew how bad the economy was going to be up to date, I wouldn't have been riding no bikes, playing no video games. I would have bought a house when I was 10. They did a study based on today's economy, like what should minimum wage be based on today's economy to make sure an American is comfortable living a day-to-day life, like with the prices, how the prices is up to date. Bro, do you know how much they say you need to make an hour to be comfortable around this? $66 an hour, bro. Who's making that? That ain't even the kicker. You make $66 an hour. You work 40 hours a week. At the end of the month, guess how much you gonna have in whole? 10 bands. Oh no, but don't think you taking the whole 10 bands. You forgot about Uncle Sam. You're going home with 6,500. Maybe a 7-ball if you lucky. Okay, so eliminate all the bills and life expenses from that 6,500. You left, even making $66 an hour after paying all their bills and life expenses at the end of the month, they only gonna be able to save a band or two a month. So regular like me and you was just cooked. We po. We just at this point we just on the internet seeing who can be po better. Who can be best at being po?
This is what the government is doing to its people. They are robbing us and our children and our children's children that are not even born. But Mitch, can you explain how triple-digit increases in medical insurance can cause all of the trends that I just went over to increase? And one more time, you guys, total household debt, almost 1.5 trillion behind 7.8% delinquency. Mitch, how will the medical costs surging cause all of that to accelerate?
It is an irrefutable fact that liabilities that are greater than assets is the definition of bankruptcy. And what that gentleman was just describing is that statement. Assets greater than liabilities equals bankruptcy. That applies not only to humans, as in the normal population, but that also applies to governments. They have run the ship into the ground. It's the compound cumulative effect of the interest on the bonds, not just at the school districts and the central appraisal districts, but at the banks. The banks themselves get money, they loan money out, they raise bond money. At the tail end of the day, that statement is irrefutable. Over and above that, no one on this planet can get blood out of a stone. The money does not exist to pay off the real estate tax, which is created based on fraudulent, outstanding school district bonds. The money does not exist to pay for the fraud in terms of the healthcare costs. If you go to the hospital and you are unfortunate enough to have to stay overnight, all of a sudden, a $40,000 bill shows up for the privilege of staying in the hospital overnight. Yet the insurance company will settle that $40,000 bill back to the hospital at roughly $3,200. Well, that means that the hospital committed mail fraud. Now, the hospital will turn around and say, well, but we need this money to offset the other overhead costs. Well, isn't it interesting that on either circumstance, be it the central appraisal districts and or the school districts themselves, when you ask for the check register, well, that's nowhere to be found. We don't want to talk about that, including the Attorney General for the state of Texas has refused to turn it over, including the state comptroller that has refused to turn it over. You get the same approach from the hospitals. You get the same approach from anybody that is supposed to be writing a legitimate check, and yet is nowhere to be found because that perpetrates the fraud. And this isn't just an administration, 2 administrations, 3 administrations. This has been going on for years. But the compound effect of what they have done in the last 30 years by the creation of these perverse, sick, demonic ideas, well, we're going to do this for this segment of the population, when the net result is you bankrupt that segment of the population. And as I said, this is a domino effect. The 22 million isn't even close. It's a talking point. I've read 4 reports. Not one of them had the right number. Nobody knows what the right number is because you can't quantify the domino effect. If all of a sudden, let's say 15% of your population, your working population can't afford anything, now what are you going to do? The restaurants associated with them, the grocery stores, the ability to buy gas, ability to buy cars, it's twisted. The only thing that can be done in all of this is put a floor and a ceiling, locate the fraud, call it what it is, and start peeling it back. There's enough people, enough employees in the government, i.e. the SEC, who's got subpoena power to do this. But the idea of constantly kicking this can down the road is just adding to the compound cumulative effect of the interest, which cannot, under any circumstance, be paid.
You know, and so far, Mitch, all we've done is show the viewers household debt. So all we've done, guys, is showed you household debt, and then we've showed you incoming expenses to Americans because it's the American consumer that's propping everything up. I would argue across the world, actually. So the important thing about understanding that is once enough of mom and pop can no longer afford to pay, everything comes crashing down. But having said that, I also want to take a look at the commercial mortgage-backed security market and private equity. Let's see what's going on under the hood there. We're going to take a look at troubled commercial loans on the rise. In the past 2 years, we have witnessed a steady rise in delinquent commercial loans, even as outstanding balances have fluctuated. And I'm going to calculate the amounts here in a second. This is really hard information to get because it's not everything, and this is levered up. There's a hedge market, but we're just going to see what's on the surface. Now, we're going to look at 3 categories of commercial loans: C&I loans, CRE loans, and multifamily loans. Now, first of all, over 2 years, when we look at all commercial loans, the delinquency rate is up 83%. When we separate that out into categories, C&I loans are up 42% over 2 years, but CRE loans are up 100%, and even crazier, multifamily over 2 years has a delinquency rate 481%. Okay, so the way we're going to do this is we're going to try to calculate what the delinquency rates are, and we're going to use these debt amounts right here. So for multifamily, it's saying there's about 6.7 trillion. Now lever that up, and how much is there? For C&I, they're saying about 23.2 trillion. Again, lever that up and see how much is there. And for CRE loans, it's about 25.09 trillion. So when we try to look under the hood and we try to figure out what are the delinquency rates of some of these things, it says for CMBS, the delinquency rate right now is about 6.36%, which is an increase. So when we take the 6.36% and we just apply that to CRE and multifamily, that means there's $2.02 trillion in just those 2 categories of debt that are currently behind. When we look at only the C&I delinquency rate, is actually much lower. It's actually historically low at 1.28%. And I'm wondering how much of the Bank Term Funding Program allowed these people to swap assets. But when we take that 1.28% and we apply it to the 23 trillion, that gives us an additional $297 billion in debt that is behind, for a total combined amount of 3.149 trillion. Added to the 1.42 trillion of consumer debt that's behind gives us $4.56 trillion in debt right now that is not being paid off. Now, all of that is going to create a massive problem for our economy. So, Mitch, do you think that the medical insurance costs going up the way they are is the black swan event that we've been waiting for that's going to tip our economy into the next Great Depression?
I've been saying that nobody knows which one of these canaries is going to die first. It literally could be London. It could be this problem with the healthcare costs. There's a lot of problems, but no matter how you cut it, and no matter what it is that you're looking at, no matter what that issue is, you run into costs that the median household income under no circumstance can pay for. So anything over and above that median household income, by virtue of the fact that it can't be paid off, the bonds, whatever it happens to be, credit card loans, et cetera, is in one form or another associated with fraud. They've blown the bubble so large that it must collapse. It will collapse under its own weight. And what you're seeing here, when it turns out that if the government doesn't do something with regard to this issue, do you realize that that would put roughly 20 million people in a position where they're now criminals? Because the law says you're supposed to have health care. insurance. If you can't afford it, they made you a criminal because you can't afford it. You didn't do anything wrong. So is this bad enough? Absolutely. Are they going to do something? More than likely. But is it what they're going to do? Fix it? Not a chance, because they refuse to get dirty. And that's what this is going to take. You're going to have to get in like we've been doing on the real estate taxes and call BS on BS, call BS on fraud. You've got to point this out. Some serious people who have brain power can sit down and put a floor and a ceiling on this and start peeling it back. The SEC's got the authority. And that's what's going to have to happen here. You cannot let this fester, because even if you kick it down the road another 12 months, you're going to be right back at the same spot, except you've got another 12 months of compound cumulative interest on top. You can blow it up, but you're going to wake up one day and the whole thing will crash. And the point of what we're doing is to say, let's try to do controlled demolition rather than complete annihilation.
Yes, sir. And before going to our final thought and conclusion, let's listen to one quick segment from Jamie Dimon.
Where do you think we are in that bull market? Is there any complacency there? Is it underpinned by rational factors? Is there more momentum?
Yeah, look, we're in a bull market. It's been clear. Asset prices are high. Credit spreads are low. Consumer's still okay. The consumer has jobs. Remember, the jobs is what usually starts to force people to cut back and change things, and consumers spend less and companies cut back. So far, so good. There are a lot of issues out there that, the economy's got to deal with, from all the geopolitical stuff. Maybe they'll start out well. What's going to happen to inflation? I'm a little more nervous about inflation not coming down like people expect. That might be a surprise. On the other hand, there's a lot of spending. There's a lot of government spending, which is inflationary too, by the way. And so, I don't know. I hope for the best, plan for the worst.
And you're not worried about a recession in 2026 for the US. You made that clear.
I think it could happen in 2026. I'm not worried about it as a different statement. We'll deal with it. We'll serve our clients. We'll navigate through it. A lot of us have been through them before. You don't wish it because, certain people get hurt, but it could happen in 2026.
We're still, of course, in the US government shutdown.
But I do think there are positives, like deregulation is a real positive, which also helps animal spirits as a positive. And, in the one big beautiful bill, there's also more stimulus that has positives for the economy, but maybe negatives for inflation. So how it all sorts out, we'll see.
Markets are looking through the US government shutdown. Is there a period of time, if this shutdown continues, where markets start to wake up and become concerned?
I don't think so. I don't like shutdowns. I think it's just a bad idea, and I don't care what the Democrats, Republicans say. It's a bad idea. It's not a way to run a railroad. I don't think it's critical. We've had, I forgot the number, 4 or 5 or 6. One of them went for 35 days. I'm not sure anyone really affected the economy and the market in a real way.
Mitch, can we get your final thoughts?
On one hand, Jamie Dimon is preaching his book. On the other hand, what he's saying doesn't stack. So nobody is going to go to work for jobs, when at the tail end of the day, they have no money, less than zero in their pocket. Doesn't make any sense. You're screwing around with human nature. Second of all, deregulation. I was literally reading about this last night as to what was the attempt and what the thought process is. Well, we're going to deregulate these smaller banks. It simply isn't true. What they're saying is, well, we're going to allow you, the banks, the smaller banks, to have less equity in the bank so that you can put out more real estate loans. But here's the point. It's a 1% delta. It literally goes from 8% to 7%. Big deal. It didn't do anything. Didn't move the needle. And it also doesn't change the underlying fact that if they knew what they were investing in the first place, they wouldn't be putting out the money, i.e. in the multifamily loans that they've been pumping, where this multifamily product, a lot of it's going back to the banks. If your cost to build a multifamily unit is $300,000 per unit, do you realize that's $3,000 a month in rent? We're coming right back full circle. The median household income does not exist to pay for it, period. So the deregulation is nothing more than, here, little boy, have this lollipop, go away and don't bother me. They're painting a narrative. That's exactly what they're doing. It simply isn't true. And there was a bank that I'm very familiar with in Tyler, Texas, where the owner of that bank happened to be a billionaire. And when they tried this crap in 2007, the federal government came down on his head and he said, screw you. I'll turn this into my own private hedge fund. He deregulated himself. He pulled it out of the banking industry because his business was built on loaning to farmers. He knew his business. That guy gets kudos, AAA stars, because he knows what he's doing. He got away from the nonsense. And unfortunately, that is what is going to happen. People that are the true capitalists are going to recognize what's going on here, the same as we have, and to say, you've got to fix it. You've got to get the fraud segmented out, and you're going to have to deal with it so that the true capitalists, the people that know what they're doing, can get busy and start rebuilding from the bottom up without the fraud.
Thank you, Mitch. That was a great final thought. And I'm going to say my conclusion is going to go towards people that are struggling right now. And I want to relate with you guys. First of all, what I want you to know is you're not alone. I'm low class right now. I'm not middle class, you guys. I'm a lower class person right now. And I'm going to tell you guys, I'm getting thrown around like a rag doll, trying everything I can think of to maintain my purchasing power. So you're not alone. And some of the things that I've learned through all of the tragedies that I've been through and even the poverty that I've been through is we can never lose our hope. We have to maintain our hope, rebudget, learn how to save money, rearrange our life. Yes, all of that's true, but don't lose hope and work on the relationships in your life. In other words, if you're depressed or you're internalizing things, think of other people and try to love everyone. Having a servant mentality is the best way to live. And that's also for husbands. Husbands, you're supposed to be servant leaders, not just leaders, servant leaders. So because there's really nothing else that we can invest in right now, I say invest in you, invest in your family, and learn to love your life no matter the circumstances in the economy. We hope you liked this video. Let us know how we did. Let us know if you wanted that breakdown and if you appreciated it, and share this video, like the video, keep watching it. Everything's chaptered. Go to our websites. And other than that, if you're out there investing in real estate, you guys already know we wish you luck and we hope you win.